Good evening, everybody. My host, good evening.
Yeah, good evening, sir. You're welcome. Go ahead.
Okay, thank you. I'm Kazim Mwidi by name. Welcome to FCA online platform. We have so many issues to discuss. Just with that time we allow us. We have sub and D shape. Sub and D shape. Then piecemeal acquisition. Sub and D shape has been the most regularly tested area in Ican exam. The most regularly tested area in Ican exam. Tested severally. What are those things that need to take note in sub and D shape? One, determination of date of acquisition. What is the difference between the two? Subsidiary, which is also known as vertical group, and the complex group, which is also known as the D shape. The difference between the two is that A acquire BICO, BICO acquire SICO. ACO will now have a direct investment again. It has both indirect and direct investment is indirect subsidiary. That is the difference between the two. ACO, BICO, and SICO. ACO acquire BICO, BICO acquire SICO is different from fellow subsidiary. Fellow subsidiary, the parents acquire the two subsidiaries directly, direct investment. But indirect subsidiary will exist when the direct subsidiary have control in the indirect. Don't be deceived. It's very easy to understand. How? You look at the question. ACO acquire BICO. BICO now acquire SICO, not ACO now. BICO is a subsidiary of ACO. It now acquires SICO. Immediately acquire SICO, it must be at the concept of ACO. ACO must give approval. You cannot just go and acquire without the knowledge of ACO. It's not possible. Because he has control over BICO, he must make the decision. He must, even though he has seen business opportunity in SICO, it must be approved by ACO. Therefore, the day BICO acquires SICO, SICO becomes a subsidiary of ACO. But what type of subsidiary? Indirect subsidiary. Indirect subsidiary. Therefore, he has both direct and indirect subsidiary. BICO is a direct subsidiary of ACO, while SICO is an indirect subsidiary. Why is he indirect subsidiary? ACO did not buy him direct. It was bought by BICO. When I give me the exam on that day, and if it is sub, I must establish the single facts to determine the date of acquisition. It is very, very important. That is one of the number one thing you must put into consideration before going ahead. We decide to pick this over this shape first because of the numbers of times that has been tested. 2016, May. Has been 10 times. So many times. Therefore, it is, in our opinion, that it should be treated before the piecemeal acquisition. of acquisition. They can only test all these three ways. First one, the same day. ECO acquired BICO on 1st April 2011. The same day, BICO acquired SICO on the same date. Both will have a single date of acquisition. One for 2011. He has control over the two. Don't argue with the question. Don't edit the question. So why is it that 2011, the same day, is it that he bought one in the morning and subsidiary go and bought one in the afternoon? That is not your own issue. The second one, look at this one. These two are regularly tested. If you don't pick your retail earning very well, if you don't pick the retail earning very well, it will backfire. The goodwill will be wrong because it's the retail earning, the day he has control, is the retail earning I will pick. They will not give you different retail earning to pick. You must know your scenario. Now, ECO acquired BICO on 1st April 2013. ECO 80%. He has control in BICO. BICO now acquires SICO 1 for 2016. BICO acquires SICO 1 for 2016. I want to ask you, class, what is the date of acquisition? I want to ask you, what is the date the parent has control? What is the date of acquisition? If you look at it very well, ECO does not have control over SICO in 2013. He only has control in SICO in 2016 when BICO acquired SICO. This will have two dates. ECO to BICO 1 for 2013. ECO to SICO 1 for 2016. This one has been tested. This one has been tested. ECO acquired BICO 1 for 2013. BICO now acquires SICO 3 years later. The day BICO acquires SICO, that day SICO becomes indirect subsidiary of ECO. That is the second one. The third one, ECO acquired BICO 60%. BICO has been trading with SICO initially. BICO acquired SICO in 2016. On 2018, 1st April 2018, ECO now acquired BICO. Definitely. What is the date of acquisition? ECO to BICO 2018. ECO to SICO 2018. The day he acquired this has been trading initially. So immediately ECO acquired BICO, SICO ceased to be parent of this. Both of them are now subsidiary of ECO. BICO is the direct subsidiary, while SICO is indirect subsidiary. This theory, you must know it. The two of the first one and the third one will give the same dates. We give the same dates. Before I proceed, why are we doing this? The question will not give you different retail earning. Look at it. Some question will not give you different retail earning. You have to now pick your choice on it. Immediately you pick wrongly. Immediately you pick wrongly. That is a problem. Let me show you what I'm saying. Look at this. Bola acquired 60% share capital on November 2012 and 10% in Gabriel. He has simple investment in Gabriel, but he has control over John. On 1st November 2013, simple investment in 2013. But in 2012, he has 60% control. John PLC now. John now acquires 70% share capital of Gabriel on which date? November 2013. This is the second one, 2 dates. Date of acquisition. Bola to John, 1st November 2012. Bola to Gabriel, the day John acquired Gabriel, which is 1st 2013. On that day, Gabriel became a subsidiary, indirect subsidiary of Bola. They will not give you different retail earning. The balance in retail anywhere as follows. Pick your choice. The training to pick for John, 1st November 2012 to 70. The training to pick for Gabriel, 240. Because he has control over Gabriel in 2013. That is the purpose. The day he has control is the day we have to consider. Some questions will first of us take you first. They will not take you back. Let me show you again. Some questions will put you up and down. You must be able to determine what is the date of acquisition. If you get that wrong, that is a problem. Look at this one, Temi. Temi acquired 90% of ordinary share capital of Funshaw and 26% of the ordinary share capital of Sunshine on 1st December 2003. Use share for share exchange. Let's leave that. He has given me the net asset on that day. If you go to additional information, if you go to other information again, Funshaw had acquired 60% of Sunshine on December for a consideration of 50. Funshaw has earlier acquired. What is the date of acquisition? Anybody that used the net assets of these dates, 50 million when the retail earning of Sunshine, and the fair value of the net assets was 80. Anybody that used this one, Ican will do welcome back. Come back next diet. Because as at these days, it does not have control. I need to go back up again because 2003 is the date he acquired both of them. You fall into the third one. Some question will take you first. After you go back, you go up again. Yes. Get the logic. That is what we are saying. This is this shape. He has direct investment. This is the only one they have been setting in this shape. They've not set the other second one, which I will endeavor to send tomorrow to the platform for you to see. That has been done in the physical class. When the combination of their shares give control over the others, the indirect subsidiary. For example, ECO has 60% in BICO. BICO now has 30% in SICO. ECO now has a direct investment of 30% in SICO. I must consolidate them. The combination of the shares, has it given me control? Yes. Ican has not tested that. When the combination of their shares will give control, the one they've been testing, the indirect subsidiary, we have direct control like this one, 60% holding. Sometimes it can have 40%. The parent will also has 20%. The combination of their shares has given control. That is another case, which has not been tested before. Having said that, the next thing we need to know, how do I determine the effective interest? How do I determine the effective interest? It's very simple. ECO in BICO, parent has 80% and 20%. ECO in SICO is a multiplier effect. Let me see. 80% times 75%. That will not give us the 60%. 80 times 75%. 80% times 75% to give me 60%. The first one, ECO in BICO, 80%. Parent is 80%, NCI is 20. ECO in SICO, 80% times 75%. You now give me what? 60%. 60%. 60-40. That is it. We are seeing the date of acquisition. If we don't join the class on time, we have so many things. There will be drawback and it will be consuming our time. Okay, but no problem. We have 3 dates of acquisition. Date of acquisition. I want to know the date that ECO has control in both of them. ECO has control in BICO, 1st April 2011. He also has control in SICO, 1st April 2011. The same date. They will not test this one for you. ECO in BICO, 80% on 1st April 2013. BICO now acquires SICO on 1st April 2016. This one will give us 2 dates of acquisition. The 2 dates of acquisition. ECO acquired BICO on 4th 2013. Biko acquired Seco, different dates. Eco now has control over Seco on 1st April 2016. The date Biko acquired Seco. Then Biko has acquired Seco earlier years when Eco now acquired Biko, the same date. Two will give us the same date. One will give different dates. Then how do we determine the effective interest? I use this one as an example to determine the effective interest. Eco to Biko 80%. Eco to Seco now. You will now say 80% times 75%. That will give me 60%. Even though after you multiply, subsidiary SCI is not greater than the parent. It's just a multiplier effect. It doesn't mean anything. Go ahead. We have so many situations like that. That is how to determine the effective interest. So the remaining one, I will use question to illustrate these two. Which one am I talking about? Let's go to question, not to waste time. Cost of investment in indirect subsidiary, which is the percentage of the parent on indirect subsidiary value paid by the direct subsidiary. All those things are English. Let us go to practical application. Let's go to one question. Because we don't have so much time, let's take this particular question. Because we don't have time, I would have loved us to take 2 or 3 questions in this, but let's take one so that we can run to piecemeal acquisition and also take one question on it, if time permits us. And if not, we can study the solution. But remind me, let me send you the combination. When there is a combination of their shares, give control over the indirect subsidiary. I would like you to see that is the only one they've not tested in this shape and soft, so that when you get to exam, you will not be confused about things. It's a combination of their shares we give control. Okay, let's take this question for God's sake. The following draft statement of financial position related to Temi, a public limited company, Fusion, a public limited company, Sunshine, a public limited company, as at 30 November 2004. All figures are assumed to be correct unless otherwise stated. From the following information is relevant to the preparation of the group financial statement. Temi acquire 90% of ordinary share capital of Fusion. He has 90% investment in Fusion control. No story. Parent is 90, NCI is 10%. And 26% of ordinary share capital of Sunshine on 1st December 2003. So in 2003, he acquired 90% and 26%. 26% is an associate. He has investment in an associate in Sunshine, but in Fusion, he has 90%. In a share for share exchange, when the retail of Fusion is not 13G, 136 million, and Sunshine was 30 million. It's an associate. Do I need to share the profits by going to the retail earning? Calm down. Let me see, read. The fair value of the net assets as at December 2003 was Temi. What do I want to do with the net asset of the parents? That is not meant for me. I only need the net asset of the subsidiary. Funsho 330, correct. And Sunshine 128. Do I need the net asset of Sunshine? No, it's an associate. According to this question, so far so good is an associate. Can I say any increase in the consolidated fair value of the net asset over the carry value is attributed to property held by the companies? Okay. With this information, I will treat Funsho as a subsidiary. No storage. Let's read the second one. Let's see the go. The share for share estate, because he used share consideration for the purchase of Funsho and Sunshine on 1st December 2003 has not yet been recorded. So if you go to the accounts, cannot say, oh, he has not recorded it at all. Investments of Temi in Funsho and Sunshine has not been recorded because he used share consideration. No issue. Good. On December 2003 has not yet been recorded in Temi's book. Temi issued 150 million of his own shares to purchase Funsho. He used 150 million and 30 million to purchase Sunshine. Good for me to purchase Sunshine. There have been no issues of shares since December 2003. With this one, no issue. I can calculate it. You need to give me the market price per share of the parent because it must be issued at the market price per share of the parent. But on 1st December 2003, before the share for share estate, market capitalization of the companies. Oh, he has given me the market capitalization. Definitely, I can calculate my shares. I can calculate the market price per shares of Temi. 644 million for Temi, 310 for Funsho, and 130 for Sunshine. Do I need that of Funsho and Sunshine? No, I only need that of what? Temi. But he has not told me what is the information. Let's go to the information on Funsho had acquired 60% holding. Funsho has acquired 60% holding. Oh, with this one now, they say Funsho had acquired 60% holding in Sunshine on 1st December 2000 for a consideration of 50 million. But this was acquired in 2003. That means both Funsho and Sunshine became a subsidiary in 2003. With this information, I will now open everything. I will open it and open it wide. How wide I'm going to open it, it depends on you. So I've known that the two of them are subsidiary on 1st December 2003. Even though Sunshine has acquired earlier in 2000, but I cannot use the retained or the net asset here because it's the day he has control, which is 2003. Which is 2003. With this information, okay, Funsho acquired 60%, in Sunshine. That means subsidiary Funsho have control over Sunshine. But the ultimate parent, he has control over Funsho in 1st December 2003. Funsho has control in 2000. Therefore, the date of acquisition for both two subsidiaries is 2003. With this, I can now draw the diagram, consolidate. I'll open everything. I'll open it and open it wide. I will say, okay, no problem. PPE of the first subsidiary, parent own 3220 plus the first subsidiary plus the second subsidiary. Investment in associates. I must have read in the question. I will leave after that. I go to goodwill, leave two lines. Then current assets, total assets, equity and liability, share capital, retained earning, NCI, non-current liabilities, deferred tax, current liability. I will now open analysis of the group structure. He has control on these days. The retaining of both of them on that day, I'll just say the date of acquisition, retaining and date of acquisition, effective interest, NCI and cost of investment. I'll open it down. I will go again. Determination of net asset of subsidiary, Funsho. Determination of net asset of Sunshine. Adjusted retaining of subsidiaries. Retaining of the parents. Goodwill. I will now start my working. I've gotten the goodwill. I can now start the working. I'll open this one down. I do not understand this, sir. Please, why are we share capital? Sir or ma, please, I do not understand this question. You can help me explain further on it. Then I will now start reading one after the other again. I've opened it up, gotten that the two of them are subsidiary. One is direct and I've opened all the necessary accounts down. Jamie acquire 90%. Why are we adding to the share capital? You should know that for me to have added, there must be share consideration. Let's wait. Let me show you. Just wait. Calm down, ma. Calm down. Jamie acquire 90% of ordinary share capital of Funsho and 26% of ordinary share capital of Sunshine on 1st December 2003. Good. In a share for share exchange, when the retained earning of Funsho 136 million, they've given him the retained at the date of acquisition. He has control on that day. Even the 26%, he has control because the parent has this Funsho has in Sunshine 60% and Sunshine 30 million. The retaining that I will use 30 million. The fair value of the net assets, I don't need Temi. Funsho 330, I'll use the fair value. They want me to work from behind. I'll pick the shares, pick the share premium, and the retained earning. And out of the sunshine is 128. Any increase in the consolidated fair value of the net asset over carrying value is the, I will not post. No problem. Cost of investment 90%. NCI 10%. Group structure 90% for the parent, NCI 10%. Let's go again. Now told me the share for share exchange of purchase of future and sunshine on 1st December 2003 has not yet been recorded in Temi's book. They've not recorded it in Temi's book. It has not been recorded. Temi issued 150 million of its own shares to purchase future and 30 million to purchase sunshine. There have been no new issues of shares since that day. It must be issued share for share exchange, share consideration. It must be issued at the market price per share of the parent. On 31st December 2003, both the shares for share exchange, the market capitalization of the company, 644, they've given me the total values of shares, current values of shares in the parent company is 644 million. For Temi, I don't need it. For Punshaw, I don't need, because I want to determine the market price per shares of the parent, which I will now multiply it with the 150 million he issued to determine the cost of investment in Punshaw, and for the 26 he acquired in sunshine, I'll multiply with it. How do I go about that? Very simple. But I need to determine the numbers of shares they have given me today value. Today value, when you hear market capitalization, as at today value, this is the values of shares in Punshaw and in parent, which is Temi. What is the numbers of shares in Temi? I'll go to the financial statement, go and get the values of shares in Temi. Oh, call up ordinary share capital, 280. This is the book value, where I will get the nominal value of the shares. This is the book value at 1 naira each. Can I get the numbers of shares in parents? Yes. As I can test this, no. Market capitalization to determine the share consideration has not been tested in group accounts. What do I do? It's very simple. Look at the solution. Market capitalization, this is the formula. Market price per share times numbers of shares. I need to get the numbers of shares first in the parent, not subsidiary, parent, which equals the values of shares all over nominal value. Why am I doing it? I need to get the market price per share of the parent. I will now say, okay, equals to 280. MC, market capitalization, market price per share times numbers of shares. What is the numbers of shares? 280. Can I get the market price per share? Yes, 2.3. Cost of investment, 150 times 2.3. What is the nominal value of the equity shares? This is it. 280. MC, market price per share times nominal numbers of shares. MC is 64. Market price per share, I don't know. The numbers of shares, 280. How do I get the 280? The values of shares, the book value, divided by the nominal value will give me 280. Can I get the market price per share now? Yes, which is 2.3. Can I determine the cost of investment? Yes. 150 times 2.3, it will be debited. It's as it creates Equity shares, 1 naira. 150 times 1 naira because he issued it at 150. Share premium, 150 million times 2.3 minus 1 to give me a premium of 195, or 345 minus 150 to give me a premium of 195. It is 2 credits against 1 debit. And he said it has not been recorded. The question says the share for share exchange in the acquiring of the both the 26% and the 90% has not been recorded. How will record it? By saying debit the cost of investment with 345. Go there for good recalculation. 345. I will debit. Equity shares must be credit. I will go to the share capital. What is the share capital of the parents? What is the share capital of the parents? I will credit it. 280 plus the 150. Has he created a premium? Yes, he has share premium. If he does not have share premium in his book, I told you at the beginning of this class, it must be created. Go to higher question. Some question will not give you share premium. That is why you must leave a one line space for 2 things: gain or loss on purchase of other interest and share premium. If there is other component of equity, it means I don't need to open another one. Other component of equity, other, which share premium is part of it, 195. He also issued the 30 million. Go there, the 30 million. He issued 30 million to acquire 26%. I will still do the same thing. This is for the 90%. In Sunshine, share price is market price per share, 30 million times 69. Equity share is 1 naira. A secret a premium, 39. It has not been recorded. The question says it has not been recorded. I need to record it. It has not been recorded. I'll go ahead and record by saying, okay, cost of investment for the 26%. I will take it to my analysis of the group structure. Look at it, 69. Equity shares. Equity shares must be credited. And the share premium, equity shares, 39. No, this should be 30. And why this one is 39? It's not 20. It's 39. If you add the 2 to 3 together, it gives us 60. Sorry for that, it's 30. Not 39, not 20. It's 30. 1 naira times 30 is 30. Why this one is the difference, share premium, 39. The 2 of them will give us 69 cost of investment. My brother that is asking me why we are adding to the share capital. You know the reason why we are adding now. You know the reason why we are adding. On Friday, on physical class, I will still endeavor to solve this question again for my students in regular class. In case he has so many things that they must learn. So many. Before I proceed further, any question for me? Before I proceed further, any question for me? Thank you too. Thank you too. Let's go back to the question. has not yet been recorded in saving book. He issued 150. Market capitalization. In arriving at the fair value of the net asset acquired as of December 2003, Temi has not accounted for deferred tax arising on the increase. That means there's a deferred tax liability in the value of the property of both Funsho and Sunshine. The deferred tax arising on the fair value of the property was 15 million and Sunshine is 9 million. Deferred tax can be tested in two ways. It's either they give me like this, or they will give me revaluation surplus that happen those things, and they will not give me temporary difference. It will create a temporary difference, and they will tell you, and they will give me the tax rates. If there is a revaluation surplus, but the problem is this: at the date of acquisition and at the date of consolidation, deferred tax at date of consolidation, if it changes, is the one that will go to the what? Deferred tax liability. Ican has not test group accounts introducing deferred tax liability. We used to do that, and people can bear us witness. The highest you can get it tomorrow. So many works we are doing for you to make a successful examination. Don't worry. And if you are in Lagos, they say that the management has decided to extend the online to come for the physical class, provided they can provide evidence of registration. The management has decided that online Zoom can also join on Friday. And this question is one of the questions I've decided to solve in the class. Okay, and the class will run from 9 to 6 p.m. by God's grace. Today, SFM was done from 9 to 6 p.m. So he has given me a deferred tax. Let me recap on deferred tax. When there is an increase, it means it must have been greater than the tax base. It will create a temporary difference. Don't forget, when the carry amount of an item in a financial statement is greater than the tax base, it will give us deferred tax liability, which they help us to calculate deferred tax. But they did not say it's a liability or it's a asset. But you will know by saying increase in the value of the property. That means the item in the financial statement, the carry amount is greater than the tax base. Sometimes they will give you, go to the one, Mama PSC, Mama PSC, and Son and Papa. They give us the tax base to compare with the carrying amount. That question is also going to go on prisoner acquisition on Friday by God's grace. Then you compare it. There is another one on deferred tax. If the deferred tax are the same as DOC and DOA and DOC, I would what? Debit the reserve and credit deferred tax liability by adding to it. Like this one, he said the net asset. Don't forget he has given me the net asset, which is one. The net asset of Funsho 330. What responsible for the difference? Increase in property. I cannot pick shares. I cannot pick the shares. I will say net asset. He has given me the retaining. I cannot do the net asset now. What does he call the net asset? 330. I will pick the share capital, share premium, retail earning 136. I will sum this three together, taking it from what? The 330 balancing figure. What responsible for the difference? 64. Revaluation surplus on property, no reduction. Revaluation surplus on property, 64. How do I get the 64? By adding these three. After adding it, you subtract it on 330, 64. I will credit reserve and go and debit my PPE. I will go to my PPE and debit my PPE with 64. This 64 is in the book, 64. This is the PPE in the book, 64. He said he has created a deferred tax liability. And the tax liability, they did not say it has changed. I will now, okay, no problem. 330 minus 15, it does not change. Sometimes it changes. We are going to treat that kind of question. Effect of deferred tax on group accounts. Ican has not tested at all. What do I do to the 50? I've debited reserve. I will not credit deferred tax liability. I will go up and credit my deferred tax liability by adding to the deferred tax. Deferred tax liability, 15. Okay, I haven't said that. Can I calculate my goodwill now? Yes. Cost of investment. Cost of investment, 345. Add NCI. How? I don't know how to value NCI. Let's go to the question to see how NCI is valued. Okay, before going to that, let's go again. Pusher had acquired 60% holding in Sunshine on 1st December 2000 for a consideration of 50. That is only two I need. The percentage, all the net asset, all the retained, I cannot use because this is not the date of acquisition. I will now go back, but I will need to know the cost of investment. And has it been recorded? Then the 60% for the calculation. When does he now have control? He had control here, 2003. So I will use the net asset. I will now go back again to Sunshine. I will use the net asset in Sunshine. What is the net asset on Sunshine on this date? Of Sunshine is this one that I will use. Does it give me the retained? Yes, retained of Sunshine, 30. This is what I will use. That is why the question is very confusing. They will take you down, take you up again. So I've got my retained, I've got my net assets. I now need to, I've got my group structure. I cannot calculate. How do I know? Has it been recorded? The 50 million. I will check. Has it been recorded? Oh, it has been recorded. Investment in Sunshine. I will not calculate the group structure. I will not calculate the cost of investment, the effective interest in Sunshine. Let me show you the solution. The effective interest in Sunshine. 90 times 60%. Look at the table. 90 times 60%. The percentage of the parents is what I will use to account for everything. 90 times 60% plus 26,000. It will give me 80%. NCI will now be 20%. For the cost of investment, 90% times 50. How much he paid? Funsho paid for sunshine, 50. I will only account with 90%. 90% of 50 plus how much he paid for the 26 using share consideration, 69. He give me 114 for the cost of investment. 90% of the 50 plus the direct investment, 26% yes, which he used share consideration to acquire and which give us the value of 69, will now give me 114. Any question? Any question for me? Okay, ma'am, I will do that. I will recap. He has 90% here for the effective interest. So Funsho only acquires 60%. 90% times 60%. But he has 26% direct plus the 26% will give us 80% control. NCI will now be 20%. For the cost of investments, he can only account for his own using 90%. Everything he wants to account for, parents will only account using 90% he gave to Funsho in sunshine. Now, he paid 50. 90% of it is for the parents. 50 is at 100%. 90% of it is for parents. Plus the 69, the cost of investment for the 26%, which he acquired through share exchange, to give him 114. Okay, where is the 60% coming out from? Look at the question. You will see where the 60% is coming out from. I understand. You are in a physical class. This kind of question will not arise. I understand it very well. Funsho had acquired 60% in sunshine. Funsho has acquired 60%. Temi is the parent. He has both direct and indirect subsidiary. Indirect is sunshine because parent is not the one that acquired it directly. It is his direct subsidiary that acquired the indirect subsidiary. Funsho acquires sunshine. Why Temi acquire Funsho? Both Funsho and sunshine are direct and indirect subsidiary. He has 90%. Temi has 90% in sunshine. In Funsho, while Funsho has 60% in sunshine. The investment of the parent will now be 90% times the amount, the percentage of Funsho 60%, plus the direct investment of 26%, making 80%. So I can take it to my cost of investment. I can determine the net asset. Which net asset in Sunshine I'm going to use? The net asset on the date of first, on the date 2003, 128. I'll pick the share capital. Share period has given return to be 30. He said the difference resulted in what? Evaluation surplus of property, which is, I will add this together, 50 plus 10 plus 30. That will give me what? 90. Minus it from 128, it will give me 38. Credit evaluation surplus, credit reserve, and debit the PPE plus 38. Plus 38. Plus 38. Plus 38. Yes, I'll go to the next one. If you look here, the question does not give us the decision direct. It gives us in the second information. The fair value of net assets with the increase in the fair value attributed property held by the company. Property is depreciated within the group at 5% per annum. He now add the depreciation. He add it. I can now calculate the depreciation. I will debit the retained earning of the subsidiaries and credit PPE. He add the depreciation here. Let's go to the depreciation. Okay, solution. Let me show you the solution on the depreciation. Oh, first side, the depreciation. Now, how do I get the 3.2 for the depreciation? Look at it, the revaluation surplus of how much? 64, 5%. If we times 5% of 64 cost per annum, it's charging 5%. 64 times 0.05, it will give you the 3.2. It will give you the 3.2, which I will credit the PP and debit with source account with 3.2. So I'll go up the PPE. I will go up and take and credit the PPE, not 32, 3.2. 3.2. How do I get it? The revaluation surplus times depreciation is supposed to charge on the surplus. It does not charge depreciation on the surplus. What I'm saying, the question says there is a revaluation surplus. Yes, there is a depreciation of 5%. There is a depreciation of 5%. How do I get the depreciation on the surplus? 5% on the surplus. Bring your calculator out. Don't know why that one escaped me. Maybe I just do it at the 64% need to charge depreciation on the way we have been doing on any revaluation surplus and assets. 64 times 5% will give me 3.2. What do I do to the 3.2? I will remove it from the adjusted return of the subsidiary, 3.2. Then I will credit the PPE minus 3.2. Minus 3.2. There is a depreciation, minus 3.2. Then again, look at it. On the other one, Sunshine, there is a revaluation surplus on Sunshine of 38. 38 times is 0.05. 38 times, I've taken my calculator out. 38 times 0.0, 1.9. Sunshine account, I will debit this account for not charging the depreciation correctly on the revaluation surplus of 1.9. Then I will credit the PPE. I will credit the PPE of 1.9. 1.9. The retained earning at the date of acquisition. The retained earning picking from the question, as per SOP, adjusted retained earning as per 138, 135, as per statement of financial position, then the decision that did not charge correctly are put. That is that. Then I'll go to the next question. Jamie purchased 40% interest in Micro, a limited investment company on December 2003. The only asset of this company is a portfolio investment, which is held for trading purposes. Oh, when it is held for trading purposes, I can only value it in line with IFRS 9. He acquired 40% interest in Micro. How much does he pay for it? He said 11 million. And I can only value it. Why? Because if investment is for trading purposes in line with IFRS 9, financial assets, equity can only be valued, okay, if there is a transaction cost. If it is fair value through profit or loss, I will expense it to the pure head. But if it is fair value to other comprehensive income, I will add it to the purchase price according to IFRS 9. IFRS 9 says equity investment. He purchased 40% interest in a limited company, investment company. The only asset of the company is a portfolio of investment, which is held for trading purposes. They purchase it for what? 11 million. The carrying value of the net asset on this is 18. No, I cannot use the carry amount. On the day he purchases the carry amount, it must be fair value because it is for trading purposes. And the fair value was 20 million. I will use the fair value on that day, although the cost is 11. Okay, I'll now ask what is the fair value at the reporting date? On 30th November 2004, the fair value of the asset is now 24 million. A year later, as at year end, the fair value is 24 million. I will not say, take my own percentage, 24 minus 20, fair value it is trading purposes in line with IFRS 9. I will fair value. 24 minus 20, 4 times 40%. Oh, anything he give me, I will credit investment. I will credit it, return of the parents, debit investment in associates. Investment in associates. So how do we get the share profit of associates? 1.6. He bought it at the cost of 11. Has it been recorded? Yes. Investment in associates. Cost of acquisition 11 million. Share profit now. It must evaluate 24 minus 20 times 0.4. The fair value is 20. And at the end is 24 times 40%, 1.6. I will credit the return and debit investment in associates. Share profit associates 1.6. 1.6. I will go to the next question. And let me quickly see this. I will go to the next question by saying, let me read the next one. Insurance has included a brand name in property, plant, and equipment at the cost of 9 million. Brand name as part of PPE, that is wrong. Brand name can be separated, identified, and could be sold separately. The brand name can be identified separately and could be sold separately from the rest of the business. That means it must need to be shown as what? Intangible asset, brand name. Don't include it as part of the PPE. So I will credit the PPE, debit the brand name account. That is how we say you should leave 2 line space after the goodwill. The fair value of the brand name, okay. But the fair value of the brand name as of November 2004 is 7 million. But the fair value of the brand name at time of acquisition, 9 million. That's why I put it at 9 million. Now it is 7 million. That means the brand name has impaired by 2 million. By 2 million. I'll first of all remove it from PPE, by crediting PPE, open a brand name account, pass the impairment by crediting the brand name, and debit the retain any of the owner, which is the parent. That's all. That's all. That's all. Let me show you the solution. Impairment on brand name. Brand name minus 9. I open a brand name account. Then impairment 9 minus 2, you give me 7 because it has impaired. Who is the owner of the brand name? Parents or past impairments. I'll go to the next one. It is the group policy to value non-controlling interest as proportionate shares of the fair value of subsidiary identifiable net assets. Required. They've told me it is the group policy, share proportionate. Then I'm required. Consolidate the statement of financial position of Temi Group at the year ended 30 November in accordance with international financial reporting standard. Okay, share proportionate. I cannot go calculate my goodwill. The net assets is 315 after removing the business liability. 10% of 315 for the goodwill. 10% of 315, that's 1.5. Added to the cost of investment, that's 76.5 purchase consideration. Less the net asset at date of acquisition is 1.5. 1.5. In Sunshine, what is the net asset? In Sunshine, 1119. 10% of it, 11.9. Add it. Oh, is it 10%? 20%. Sunshine is 20%, not 90, it's 80% to 20. So 20% of this, 20% of 119, not 10%. 119 times 0.2, 23.8. I will add 23.8 to it, 23.8. Then we'll let the net asset, 18.8. Goodwill to be calculated. They said there was no impairment. They didn't talk about impairment. Definitely there's no impairment. 61.5 plus 18.8, that will now give me the goodwill to be reported. Then I cannot adjust retain earning. Oh, 134.8 after removing the 3.2. I will take it to the statement of DOC. 134.8 minus 136. It gave me loss because DOC minus DOA, a loss of 1.2. How do we share the loss? 90% will go to the parents, 10% to the NCI. Parents share profits. 90% of the loss, 1.08. NCI will take the remaining one. NCI will take the remaining one. Where do we do the NCI? NCI will not take the remaining one. NCI will take the remaining one. This is the NCI. In future share of post, the loss of 1.2, 10% of it. Then in Sunshine, I can do the same thing in Sunshine. How do I go about doing the same thing in Sunshine? It's very simple. How? Okay. Adjusted retaining of Sunshine. Adjusted retaining of Sunshine. 35 minus 33.31. I'll bring it down to give me post of 3.1. How many is the parent collecting? 80%. It's collecting 80% of 3.31, 2.48. Then the remaining will go to the NCI value. The remaining will go to NCI value, which is 0.62. The last one, I only accounted using 90%. I will now reduce the NCI on the cost of investment. I will reduce the NCI by saying how much does Future pay for Sunshine? 50. I only use 90% to account for everything. I will reduce the NCI value by 10% because I only use 90. If I use 60, I'll reduce the NCI by 40. 0.1 times 50, reduction in NCI by 5 to give me 26.38. So addition of the two will now give me NCI to be reported. Give me NCI to be reported. Reduction in NCI. How do I come about the reduction? Okay, any percentage you use. Look at the question. He used 90%, 90%, 90% of 50. The remaining, if it is 70 or 50, 30, I will reduce NCI by 30. 10% reduction in NCI. I will reduce NCI by, they cannot be at 100% because I use 90% to account for everything, to take my profit, to calculate the goodwill, to do everything. So the remaining percentage must be used to reduce the NCI by 10%. That is it. When you have done that, that is the end of the question. That is the end of the question. Any question for me? Any question? Okay, I cannot consolidate. I cannot consolidate. I cannot consolidate. Okay. The share capital of the parents plus the equity share that come from the issue of 150 shares, plus the share premium, which is equity share issue of 30. This one is 30. 280 plus 150 plus 30 will give me 460. For the share premium, 39, 195, and 30. The one that is in account of the parent already, 264. It's any 121. NCI value. Then the deferred tax, 15 plus the 9, 15 in insure 9 to give me 69, and deferred tax liability. I'll sum everything together. Was that of the what? PPE of the parent plus the first sub, second sub, evaluation surplus on PPE at date of acquisition 38. When the second subsidiary, he has a evaluation surplus. Then the position of 3.2 and 3.1. Then the brand name that is included in the PPE to give me 665.9. Investment in associates 12.6. The brand name has impaired was 9 before, but at reporting date was 7. It has impaired by 2, which is 7. The goodwill is 80.3. Then goodwill, 1.5 plus this will give us 80. Current asset 218. Total asset equals to total liability. What is that? Any question for me? Any question for me? You see, states are maintained. If you are in Lagos, and probably you can find your way on leave, and you don't have any commitment on Friday, you can come to the center, provided you can prove that you are a bona fide student of FCA Zoom revision, or you are the lecture is for only registered students of FCA, nothing more. Last night it was free, but this time around, this was only our people. Any question? Let me use the opportunity to quickly talk about piecemeal acquisition before I leave. What we can do, we have done. For those outside the Lagos, we are very sorry there's nothing we can do. But even the management is try all possible means to accommodate to people. There's no way. The only thing we can do for what we have done, you can call us, ask questions. We have not having the technology to do that yet. The technology to do that is not available now. You understand your pain. We feel your pain. In short, if not for Zoom, this will have been possible, if not for COVID. That is one of the benefits of COVID. Okay, that we come about with Zoom lecture. And to say the fact, the Zoom lecture is not profitable. But we have to do it to make sacrifice for those outside the Lagos state. Outside Lagos state. But we are seeing, by God's grace, every year we get there where we can have in our live class and you will be seeing me solving the question on the board. By God's grace, we are working towards that. By God's grace, we get there one day. Okay, what do we mean by piecemeal acquisition? Acquisition in stages to have control. But what I will do, for those outside Lagos, I will send questions that we solve there, their solution on some question I think is important. The way I've done for the group cash flow, that I saw so many questions on the cash flow, I think you can manage that for now. For now, that's the only thing we can do. Management has tried to accommodate you people. Okay. Like this question on piecemeal, I'll find a way to send it to you to look at it deeply. Papa, mama, and son. This is COVID. This particular question tests our knowledge of the factors. On Friday, by God's grace, it has been pending for solution. And I purposely leave it to the 9 minutes. So we solve this. I think the solution is on the platform already. It's a piecemeal acquisition question with so many diversity. Okay. It's a piecemeal acquisition. One fellow subsidiary with piecemeal. Okay. Now, what do we mean by piecemeal acquisition? Piecemeal acquisition, it means acquisition. The first acquisition does not give control. Subsequent acquisition give control. But in exam, they cannot test you more than 2. In a practical life, it could be more than. But I'm sure in exam, they cannot give you more than 2. For example, you acquire 60%. You acquire 6% like this question. He acquires 6%. Thereafter, he acquired it on 1st June 2007. He acquired 6%. It's a simple investment. Thereafter, he now acquired additional 64. Does he have control? Yes, 70%, not 705. 70% control. From simple investment to subsidiary. We can also have from associate to subsidiary. The one of 2017, it was from associate to subsidiary. Like this one, man acquired 40%. He later acquired additional 20, meaning he has control 60%. 60%. The return of this day of 20 must be used. The net asset of this day, the day he has control. The day he has control must be used. Then the fair value of the previous investment must also be known. Sometimes they will not give you, you use the market price per share to calculate it. That is what we are saying. I don't know how far we can go because we only have 10 minutes more. We have 10 minutes more. Okay, let's take no more COVID Limited acquires 75% controlling interest in 5G Limited in 2 stages. In 2 stages. I will look at the first one. Don't confuse this one. It does not have a control in the first acquisition. In 2001, no more COVID acquired 15% equity interest in a cash consideration of 10,000, 15%, simple investment. It does not have control, 15%. It's different from he has control already. He now buy more, purchase of further interest. He has 60%. He bought additional 20%, purchase of further interest. We are not talking about that. We are talking about the first acquisition does not give control. It was the second one, like this question now. Oh, this investment, 15% cash consideration of 10,000. This investment is reported in using IFRS 9, fair value to other comprehensive income. There is a problem, and 2,000 has been reported in the OCI. There is a problem already. How? Because he now acquire additional 60%. They are not in the same line of reporting. What is the replicate of OCI in the statement of financial position or that component of equity? And what is the replicate of profit or loss, profit for the year in this statement of financial position, retained earning? So the 15%, 15% is a simple investment reported in OCI. Subsidiary is reported in profit or loss. They are not the same line of reporting. Any return reported in the OCI must be taken away and taken towards retained earning to be on the same, because there is no longer simple investment again. Investment has become subsidiary. It must be derecognized. For cash consideration of 60,000, when the identifiable net asset was 80, the net asset on the day he has control. And it is the group policy to measure NCR to measure in line with IFRS 3. On the date of acquisition, the previous 15% interest had a fair value of 12.5. How much was it before? 10,000 plus previous investment of 12.5. How do we calculate the goodwill? I will say consideration transfer to have control plus the fair value of the previous investments. That will give me the total cost of investment. The goodwill will change slightly. Fair value of the previous investments plus the consideration transfer to have control. I will not less add NCI to it. then let's net asset at date of acquisition, and it's using share proportionate. I'm not sure that COVID is outside the COVID solution. I don't think it's here. No COVID. I can send the solution later. The fair value of the remaining investment, the fair value of the previous investment. To calculate goodwill, the consideration transfer to have control plus the fair value of the previous investment. I will solve one question on audio before, let me see, on Sunday on piecemeal acquisition, the way I've done for Wisting Group, I will do the audio with the solution and send to you. So if you now have any question, you can get back for it. Thank you. This is how far we can go. Thank you very much. Any question for me on what we have done so far, or any group accounts issue that is bothering your mind? Can you please throw it to the system? Let's use the remaining 15 minutes on anything at all concerning group we have done or we have not done, or anything pertaining to group accounts that is bothering you. Let's see. Let's use the remaining 15 minutes or 30 minutes to do that. Any question concerning either cash flow or group cash flow or simple cash flow, simple group, fellow subsidiary, sub, disposal of subsidiary. What is the name of it? What is the name of it? What is the name of the one that is not solved? Okay, my brother. Say more clarification, sir. The fellow subsidiary question 3, not solved. Please send the name so that I can send the solution, please. Foreign subsidiary. Yes, we need to translate. We need to do this translation better. Okay, let's see what I can do on foreign. Let's see. Maybe I can solve one and send 2. Okay, more clarifications are on goodwill proportionate to NCI and full goodwill method. NCI can only be valued in 2 ways. It's either it is fair value or share proportionate. If it is fair value, the goodwill I've gotten using fair value, the goodwill belongs to both the parent and NCI. But that of the share proportionate belongs to who? Parents only. Now, how do I know in exam that NCI is valued at fair value? 1, the question must supply to me market price per shares of subsidiary or NCI. I think I've sent audio on this. Then fair value of the old subsidiary, they will give you where I multiply the percentage on the fair value of the O. They will measure the name of the subsidiary. That if you want to buy the subsidiary at 100%, then the fair value of the subsidiary, they will measure it, and it does not buy up. I will multiply NCI percentage on the fair value of the O. Then goodwill attributed to NCI and NCI at fair value. NCI at fair value. If it is share proportionate, but for fair value, they must tell you it's the group policy to value NCI at fair value. For share proportionate, when the question is silent, and the second one, it is group policy to, like the one we did now, to measure NCI as share proportionate. They've removed that from the syllabus. Work back now. Area of concentration and theory aspect of to read. Yes, there are so many theory on group accounts. I used to send, let me see what I can do. The area of AOC, it's very difficult. I will advise you read all. Ican is very, very difficult to predict. Look at last diet, fellow subsidiary. Last two diet, fellow subsidiary. Don't be surprised, you get to the exam, you see fellow subsidiary. They are very, no permutation. They are very, very difficult to predict. They are very, very, we are just trying to see, okay, what can we do within this short period of time? That's why we do all those ones. How can we use information given a statement of change in equity to solve a group question? I've not seen. Maybe you are talking about working back, statement of change in equity to get the goodwill, to get the NCI, all the adjustments. Me, I've not seen, but nobody is island of everything. In case you have seen one like that, please, I would like to see. I would like to see. And what you have said now, I will also research on it. I think it was in the work back before. They will give us one leg and statement of change in equity. I don't think it is probable more anymore because there's no work back. Okay, I've said that. So can you please let us have question and solution on foreign subsidiary? Thanks. Okay. Brother Peter Shegun, I will try. I will try. No. You are missing it all. March, July 2020. They are just emphasizing what is in the retail earning. They have just emphasizing retail earning date of acquisition was given there. If I show you, you will get it. It's not working back. It's not using the information. They want you to relate to the retail earning. It's very simple. You are talking about Doro question. No. Because you don't understand that statement of change in equity, that's why you are saying so. It's not. Yes. It's just to determine the return at date of acquisition. How do we determine? If you go to the question, you will see it. You will see it. Just to determine the return at the date of acquisition. It's Doro question. It's not that they are using it to get, just to get the return at date of. Immediately you understand statement of change in equity and they give to you, you will see it. You have 7 minutes more. Any other question? Yes, you can see, call me or text me, chat me. In case you have any issue, you can text me, call me. In case you have any issue, you have my number already. So in case you have any issue, you can do that. I'm very grateful. It's a privilege to be your tutor and guardian in this diet. Thank you very much. Those care about the exam, establish confidence that you are going to pass. No, they use contingent consideration, specific targets. They give this country, go and look at it. It's the same that consideration was paid using specific target. No contingent consideration. There must be specific target. And they also give them different consideration. And discounting rate is applied. They give the discounting rate in the question up. Go to the question, you will see. They give the discounting rate for the different consideration. And for the contingent, they don't want them to, they do not specify so that you're not discounting it. Which is also applied sometimes with this discount contingent consideration. Okay. I wish you all the best of luck. Have a wonderful day. My host.
Good night, sir.
Oh, thank you, my host. Thank you for part of the class today.
All right.
You
Good night.
can, yeah, good night. You can end the class.